When a retail trader finally passes an evaluation and gets the email confirming their $100,000 funded account, the immediate feeling is one of financial freedom. You imagine opening a vault with $100,000 inside, ready to be deployed. But a $100,000 funded account does not actually provide $100,000 of risk capital. Most new traders look at that six-figure top-line number and assume that is their actual purchasing power. They trade as if they have the entire balance at their disposal to absorb losses. Look at how the account is actually structured. If we strip away the nominal value, you have to stop thinking about managing a large pool of capital and start thinking about operating within strict boundaries. These boundaries are active constraints. They dictate exactly what you can and cannot do during every minute you are exposed to the market. First, they prohibit unlimited risk exposure. You cannot size positions based on a six-figure balance without instantly tripping a risk filter. Second, they eliminate your ability to wait out bad trades. You cannot sit through a severe drawdown, hold a losing position, and pray for the market to reverse. To enforce these restrictions, prop firms rely on three specific pillars: drawdown limits, daily loss limits, and consistency requirements. Learning to survive within these operating boundaries is the first hurdle you must clear before any strategy can begin to work in a funded environment. The most rigid of these boundaries is the maximum loss limit. It acts as the ultimate structural floor for your account. This is a chart simulating an active trading account. The center line tracks the continuous ups and downs of an equity curve moving forward in time. Below the starting balance sits a hard failure point. Some firms use a static line, but many employ a trailing drawdown. Notice how every time the trader's balance hits a new high, the floor moves up behind them. The space you have to operate constantly tightens. If a series of bad trades pulls that equity curve down to touch the boundary, the mechanism triggers. The account is terminated. There are no appeals or second chances. The closure is permanent. The maximum loss threshold is the ultimate measure of whether you stay in the game. It defines your foundational survival. But surviving the macro structure means navigating the micro details. We have to zoom in to look at localized day-to-day management. Inside the overall drawdown limit sits the daily loss limit. This is a short-term, immediate tripwire designed specifically to halt disastrous days. This chart shows a zoomed-in 24-hour time axis. Look at how closely this red daily loss boundary hugs the current balance. It leaves very little room for error. Imagine a retail trader takes a sudden loss early in the session. Emotion kicks in, and they aggressively overtrade to recover it. This heavy volume accelerates the decline directly through the boundary. Once that tripwire is crossed, the firm's software automatically locks the terminal for the remainder of the day, or revokes the account entirely. The maximum loss controls your long-term survival, but the daily loss serves a different function. It controls your emotional volatility. Daily limits are structural safeguards that aggressively punish emotional reactions and enforce disciplined behavior. The final structural boundary regulates your winners. This is the consistency rule. Prop firms only make money if a trader is reliably profitable. They are highly vulnerable to traders who pass evaluations through sheer luck or a single massive outlier event. Look at this profit history. We see 9 small break-even days, followed by 1 towering green bar on day 10. To prevent this, firms apply a mathematical consistency requirement. They require profits to be evenly distributed. The firm mandates this limit to ensure that a single dominant winning trade cannot make up the entirety of your total performance. Consistency rules dictate the specific architecture of how profits must be built. They reward repeatability over luck. Many retail traders with successful track records in their own accounts routinely fail their prop firm evaluations. In a personal account, you have complete flexibility. There are no artificial daily timelines, and no broker will force liquidate your position just because you are having a rough Tuesday. This split-screen chart compares the two environments. On the left, in the personal account, a trader holds a massive losing position. The curve plunges deep into the negative, stays submerged for weeks, and eventually recovers to break even. On the right side, we apply the exact same strategy to the prop environment. By day 2, the plunge strikes the daily loss line, and the account is permanently terminated. In a funded account, a single mistake or rule violation means instant failure. Because the structural rules are entirely different, a winning strategy in personal retail is distinct from a winning strategy in prop trading. Adapting to these boundaries requires re-evaluating the primary objective of every trade you take. Amateurs obsess over chasing massive targets. Professionals focus entirely on managing their distance from the risk parameters. Look at how this changes your perspective on the chart. The target profit zone at the top is dimmed out. The intense focus shifts to the distance between the equity curve and the drawdown tripwires at the bottom. Your actual job is to stay safely within the defined operating boundaries at all times. You execute a slow, methodical process, generating controlled, repeatable returns. The curve oscillates tightly and safely in the middle of the chart, maintaining distance from the hard failures below. Long-term success is an exercise in precise navigation. Market prediction identifies the entry, but the control required to stay within the lines is what keeps the account active. Comprehending this rule structure is the framework that supports all other decisions in prop trading. Before you study technical analysis, chart patterns, or market entries, you have to understand the risk architecture. Drawdown controls your long-term survival. Daily limits control your emotional behavior. Consistency limits control profit construction. To put this into practice, we have to look closely at the mechanics of drawdown. In our next episode, we will detail exactly how your drawdown limit dictates your precise position sizing. We will show how that simple mathematical reality determines your long-term probability of staying funded. In the highly structured world of prop trading, mastering the rules is the only way to master the game.